Okay, so it's going perfect. So
Hmm.
we will start with the questions. First, make a brief presentation. I am here with Kevin Withington and Craig Foster, the management team of Ondo InsurTech, and we are going to address some of the major questions I have and I have received from a lot of subscribers and holders of the company, and we will ask them. We will have four sections. The first one we will cover some questions about the growth. Then we will cover churn, dilution, and the last we will talk a little bit about their competition. The first question is on the growth on LeakBot, and it says like this: If LeakBot has a demonstrable ROI to insurers of plus 100%, why are they not firing the bound on all-in? Because I think this makes no sense to most investors. Why are not insurers trying to pursue a more aggressive rollout of the devices if they are getting such great data?
Hmm. Yeah, sure. So, um, I mean, I would counter the premise of the question in so far as I think some of our partners, especially recently in the US, are pursuing aggressive rollouts. And some of the things that we spoke about in the recent investor presentation, we spent a lot of time talking about some of the things we're testing to give our insurance partners the ability to roll out much faster than what we've done historically if they would like to. So we have partners at the moment saying, how do we get into 50, 60% of our book in short order? So the way I would break it down, Hugo, is to talk about, on the one hand, the desire of the insurance partner to roll out. And then if they have the desire to do it, do they have the ability and the tools to be able to do it? And I think they're two different questions. So, in terms of the desire to do it, that is us being able to prove to each insurance partner that there's a benefit of this to them. And they're obviously interested in the commercial benefit and the return on investment from the claim savings. But they're also very protective of their customers. So they're also very interested to see for themselves how is the customer service and the customer satisfaction, what's the response from their customers. So we have a kind of tried and tested model where when we first deploy units, we kind of prove those things out. So in terms of the customer service, that's relatively easy for us to do. We execute very well on that dimension. It's quite easy, quite quickly to be able to feed the data back to the insurance partner so they can see that themselves. When it comes to the claim saving, we do this in two ways, but it's important here to understand how insurance companies think. So if you're trying to prove to the most skeptical person in the room, let's say you've got a particular skeptic who's like the head of underwriting or a chief underwriting officer or something like that, and they say we just need categorical statistical proof that this works. They'll typically quote that they need anywhere from 75,000 exposure years to 120,000 exposure years to take a reading on frequency and severity. So so that's either one device deployed for 75,000 years, or it's 75,000 devices deployed for a year, which would be an incredibly large test. The good news is obviously they can take a view, and they're used to analysing data on smaller data sets. So what we do is we do two things. The first is from day one, we show them case study after case study after case study of things we've fixed in the home that were causing or were starting to cause or could cause damage to the home. And we find this is really compelling, Hugo, because when we show that to the underwriting director or the claims director, they will quickly recognize those leaks as exactly the things that they're used to paying claims on. So they'll say, oh, yeah, that would have been a $30,000 claim. That would have been a $25,000 claim. So we can often convince an insurer very quickly without needing to see much more that this obviously works, because they can see with their own eyes us fixing things that would have caused a claim. What we also do with each carrier is we take a control group that don't have a LeakBot, and we compare the claim saving of the with LeakBot group against the without LeakBot group. And often you can see, usually you can see the direction of the claim saving far earlier than those huge kind of sample sizes that I spoke about. So with the combination of those factors, we get the carriers to the point where they have the desire. Okay, this works. Let's push this out. So that's when I talk about the desire. That's on that side. If they then have the desire to do it, the question is, do they have the ability? And this really comes into kind of capability to deploy as many devices as possible. And that's not as simple or straightforward as you might initially think, because even the service is offered for free. Most of the carriers use an opt-in kind of marketing technique. So typically you would get, Hugo, an email from your insurance company saying, "Hey, Hugo, now with your Acme Insurance, did you know we now offer this leak detection service? You can have one for free. Click here if you would like one." So that model is the kind of primary model that we've been using across all of our partners. It's quite easy to penetrate. You can penetrate 10% of a customer base in a year using that method. We've had partners get to 20-25% of their customer base over a couple of years using this methodology. But there's a number of limitations. One, how many email addresses do you have? It's not always 100% of the customer base. Two, what take-up rate can you get on each email? Often a lot of people ignore emails, don't even open emails. Now, typically we get 10-15% take-up rate on an email campaign, on a single email campaign, but that varies by partner. But the single biggest variance is just the frequency of those campaigns. So some partners will just do lots of campaigns and keep them going on a steady cycle. But the problem is there's a single marketing team that's got a lot of other things to do. LeakBot's not the only thing that they need to worry about marketing to their customer base. So sometimes with some partners, they have a limited number of slots, and sometimes we may only get one slot a year. So if we only get to do one email per year, and only half the customer base has got an email address, and they have quite low take-ups, it's then quite a slow approach to deploying devices. So one of the things, and I won't go into the detail now, I encourage any investor, it's online, you can see it on YouTube, there's our investor presentation that we gave the other day. We went into some detail about all the things that we're testing to prove out something called auto ship, which is no longer opt-in. It's just the customer, a device arrives in the post with encouragement to install it because it's part of the policy. And we've been testing that with a number of different partners. And that would really make it much faster to be able to deploy devices into a customer base. So that's the kind of the overview. In terms of the kind of general picture, in the United States, the unit economics are such that our model of everything being free works. The business case works on a mass market basis in the US. So we find it's generally easier to prove the business case in the States. In the UK, it's we have to target certain pockets of the market, higher net worth, mid to high net worth insurers, or high risk proportions of a customer base. Because in the UK, people pay much less for home insurance, less is covered. The average underwriting per policy is much, much lower than the US. So it means our model doesn't work across a 2-3 million customer base for an insurer. We have to be more tactical about where we aim, which is the strategic reason why the US market is so attractive for us.
Yeah. I researched that, and it makes complete sense. The problem is twofold. You have like the problem of first convincing the insurer and then deploying onto the customer base. And what I was thinking is, are you doing any effort of finding like an in-house marketing team? Like, because if you are going to deploy LeakBot to many insurers, you might you will know much better how to deploy the service than the
Mhm.
insurance. So
Yeah.
this is something you are looking into.
Mhm. Yeah, I mean, so I'm actually from a marketing background. So I grew up as a brand manager at Procter and Gamble, and so we've always put a lot of emphasis within our team on every aspect of the marketing, whether it's the product design, the user experience, the getting the message, conceptual messaging right at each point in the journey to drive the right customer behavior. Now, with our insurer model, what happens is the insurer they control the marketing for the first instance. So when they send the offer to the customer and introduce LeakBot, they are in control of that part. So that's where we need to influence and share best practice. And we go to them with, look, this is how we would do it. And we show that to them in their brand. Now, every marketing team's got a different opinion. They might still change things about that initial piece of marketing. But actually, Hugo, from that point on, we're in control of all the messaging. Once the customer comes to us to order the device, every other part of the journey is under our control. And we've spent obviously a few years kind of perfecting the messaging, always trying to improve. It doesn't stop, but we've spent a lot of time perfecting the messaging on each step to drive the right metrics and the right customer behavior along the way.
Yeah. Okay. Okay. Completely understand it. And an additional question on growth is that you recently announced that the production line was increasing to 40,000 per month, but right now we are seeing a really low utilization of that total capacity. When should we expect the production to ramp up?
So, I mean, as you can see in the results we just presented, there's an acceleration in the growth rate. The reason why we made some changes, and they weren't huge changes, it wasn't a huge amount of capital investment or anything like that. We just made sure we've got plenty of headroom on in the UK factory, so we didn't have any restrictions or bottlenecks as we grow. But the important thing is the US business revenue grew 11 times in 1 year. And obviously, we've already signed insurers that insure millions and millions of homes. I mean, Liberty on their own insure 7 million homes. Nationwide insure 3 million homes. If you look at the opportunity we've got in front of us, the thing that's easy to miss is at the beginning of our journey, we signed very small high net worth UK insurers. See in the stats we just shared, we quite quickly got up to 8% penetration of that base, and that was growing quickly. Since we've then signed big carriers, we now, instead of 500,000 homes insured, our collective partners now insure 14.5 million homes. So even if we didn't sign any other carriers, just by catching up to the penetration we've already shown that we can get with our suboptimal opt-in model, the company is going to be a very big company. Never mind if we get auto ship working. So the good news is about the factory capacity. We've got the headroom. It's not going to be a restriction, depending on how bullish the case is of how fast we grow in the US. We should be able to handle it in the short to medium term.
Okay, okay. So I think we covered most of the questions of the growth section. We should go then to churn that should affect growth. So you in the investor presentation the other day you said that the average churn for home insurance in the US is around 10%, reduced with LeakBot. Let's say it goes to 8%, 7%. It is still an important factor to take into consideration. And what happens to the LeakBot? For example, if one person has a LeakBot and they change insurer, what does happen to this LeakBot? If it starts getting service, they can change and go to the next insurer.
Well, that depends. So again, at the end of the day, we are a B2B company. So our paying customer is the insurer. So that will depend slightly on what each of our customers want to do in that instance. Most of our partners would not be keen on the customer being able to switch insurance and get a discount on the new policy because they've already had a LeakBot installed, given that that insurer kind of funded that installation. But what most of our partners don't want to do is just turn the device off and leave the customer if the customer sees value in that service. So most of our contracts enable us, in the event that they switch insurance, for us to say to the customer, hey, we understand you're leaving Acme Insurance. If you would like to maintain the LeakBot service with the plumbing service, you can pay $2 a month, or something like that, and maintain the service. So that's usually what would happen.
Okay, so the what the customer will pay is lower, is less?
Well, by that point, the device cost is sunk, isn't it? So we've already recouped the initial investment from our point of view. So we would just be paying a customer paying a fee to maintain the service.
Yeah, but with this service it includes the plumbing, the free plumbing.
Yeah, that would be. There's different propositions in different markets, but just give you an idea of what the type of thing we might offer.
Okay. And this will the customer will pay directly.
Yeah, in that instance, they would, yeah.
Okay. So yes, understood. And then bigger question is like you said that on the first year is the less profitable to you in terms of unit economics because you have like the plumbing services that 10% of houses need, and you have to produce the device and ship it and all the associated costs. And if in year one you solve most of the associated risk with the leak, what stops most insurers to say in year two or year three, the ROI doesn't make sense to us anymore because you have already solved the big problem, and what is the possibility of getting another leak in the next 3 to 4 years?
Mm-hmm. Well, I'll answer the question in an indirect way to start with. So we've got 25 insurance partners. Some of them have had devices deployed for over 5 years. Not a single one of them has done that. So in some ways, it's a moot question. Our prices have only ever gone up over time, not down. So carriers clearly don't do that. The reason that they don't is because we do continue to deliver a return on investment on top of the fees that they're paying, and we're able to demonstrate that. So the thing is, although we repair more leaks initially in the first year than we do in the subsequent years, because there's a kind of an inherent underlying problem of leaks that we kind of work our way through initially, but obviously there's new leaks springing up all the time. So even after that first year, if they were to kind of cancel the subscription to LeakBot or something like that, then the claims would just go back up again because we wouldn't be catching any of those leaks as they arise.
Yeah. Okay. And another question on that. You collect a lot of data, and I assume you store that data, or it's solely for the insurer?
Yeah. So the data is all stored on our systems. So whether that's data coming from directly from the device or from the consumer interactions in the app, or even from the responses to surveys, or from even the in-home visits from the engineers. So because it's a fully integrated system, when our engineers are on site, they're also gathering lots of information, even taking photos of the things that we've repaired, and gathering information about the nature of the leak, even the flow rate of the leak and things like that. So all of that sits within our systems, and then insurers have varying degrees of access depending on what they've how they've integrated it. So a most basic kind of turnkey approach is they'll have a dashboard where they can see a view of some of that information directly from our system. Some of the more innovative insurers, Nationwide would be a good example. They've built their own smart home platform. So they have, I think we're the first product that they've integrated into that. So they've spent a lot of money building this platform, and they've integrated our APIs directly into that platform. And they've started to do clever things where in a turnkey solution, the insurer relies on us to do all the communication with the customer. What Nationwide have done is supplement our communication with their own communication. And they also offer certain incentives to the customer. So, for example, they would say to you, Hugo, as a Nationwide customer, if you install a LeakBot, you'll get an X% discount off your policy premium, and you'll have that credited every month. However, there's conditions attached. So let's say you change your Wi-Fi provider, and the password changes. So then you don't update in the LeakBot app, so we lose a connection. Normally, that would trigger a message from us saying, "Hey, Hugo, can you reconnect the device to Wi-Fi?" But with Nationwide, they would send a message saying, "Hey, Hugo, you're going to lose your smart home discount because the device is not connected. If you want to maintain your discount, you've got 14 days to reconnect it to Wi-Fi." So they start to use the data from the system to generate customer behavior that's good for the risk and good for that customer's property. So I think that's a kind of sign of things to come.
Yeah, I understand. And then the third section will be on dilution and how are you going to fund this expansion. I think, first of all, I think it's great the model you have been able to make function in the US, that basically insurance allow you to self-fund the expansion in the US. I assume in the UK and the other countries you don't have this model, or are you pushing forward to it with the new contract?
Yeah, I mean, we've over time we've just refined the model, and we've learned more and more about what works for our partners, but also what works for us from a commercial point of view. So I think that model we think is the sweet spot where the recurring revenue model is, we think, the best model for us and for our shareholders. It also suits the insurer because the cost is matched to when the claims accrue, and that's the same every year. So that kind of flat pricing model it works for both parties. The thing we were worried about is, doesn't that create a working capital problem in year one? Now, obviously, we were very focused on that, not just something that our shareholders would worry about dilution. The directors, we've all invested a significant amount of our own personal money in the venture, not least myself personally. So we also did not want to keep diluting shareholders in order to grow the business. So that's why we thought very carefully about what was the structure that would kind of be self-generative. And I'm pleased to say that has worked with our insurance partners. So I think you understand it, Hugo, already, but just to recap, if we have a master services agreement with an insurer, it'll then execute an order. So the first order might be 5,000, and then subsequent orders of 10, 25,000 devices in the future. But when they execute an order, if it's for 5,000 units, we say, okay, you have to pay us immediately the first 12-month fees for the 5,000 units. And then as we deploy them, we'll start to draw down against the deposit. But the crucial thing, so that fully funds the working capital. There's no working capital stretch from the deployment of those units. But the key thing for the model is that it's once they've deployed the 5,000 devices, if they want to then deploy the next device, the 5,001st device, it has to trigger a second order. And the crucial insight there is they may have only drawn down 20%, 30% of the initial deposit, but we don't wait until the deposit is fully depleted. We wait until the devices are deployed. And the rationale to the insurer is, well, look, the working capital cost is all in those devices, and we've put them all in. So we need another prepayment to be able to deploy the next set of devices. And insurers are quite happy with that model, and that's proven now. And to answer your question, Hugo, we've now started doing the same thing in Europe. So we did a deal recently in the UK, and we've based it on exactly the same kind of structure as we have in the United States, because we just think that's the best model for the business overall.
Yeah, it completely solves the working capital model. And in terms of growth, you have no issue there. But my follow-up question here is like, as full year 2024, you had size of 3 million cash in your balance sheet. I don't know what it will be now. And according to my calculation, that gives you a run rate of around 6 months before having your cash reserves depleted. No?
No, that's not right. We don't think we've got any needs to raise any more money and through to cash flow break even. And we think we'll be EBITDA positive by the end of this fiscal year. And it's because as we grow, we keep bringing in the prepayments from our partners, and that's really what's funding the working capital and funding the growth.
So what you're seeing is like right now with the new model, in month on month, not like on fees-by basis, but on a cash flow basis. Right now, you are uh, getting more money that you are needing to fund the business.
Yes,
So
that's
we
our
have right now not an EBITDA fiscal break even, but yes, a cash flow break even. We could say.
Yeah, exactly. That's it. We see ourselves transitioning this year. So that's why we don't see any further need to raise any capital.
Okay, and in terms of debt, do you if in the future you need capital, would you tap into the debt market? So would you maybe try to get some debt like you did in the past with HomeServe?
Yeah, well, like I say, we don't foresee the need for that working capital, but we do have some existing debt to HomeServe that we've restructured a number of times, that we think in our forecast will fully pay that off through the free cash flow of the future trading revenues.
Okay, perfect. So this is a great issue. Most shareholders and most people who are not investing in the company yet, that they do not make the math to get to the break even in the short term. But I think I made with the existing devices, you are basically on mature devices, so 60 to 80% you are getting mostly break even. With any additional devices that brings the upfront revenues. Yeah, you should get to that break even, but the markets need to see the numbers. Start to
Yeah,
show that.
yeah, for sure.
Yeah, the next question is that your business is great because you can basically know what you will earn with all the devices you have going into the future. So into the future, are you planning on issuing guidance in terms of the target you are looking for new devices or on IRR and things like that, expected growth? Is this something that
Yeah, I think all of those things will come in due course as the business matures and as we grow. So obviously there was no guidance in the market at all until last year. Now there's obviously analyst reports from our stockbroker with forecasts in for the first time. And there's obviously a lot of upside on top of those projections as well. They're kind of based on like modest base case kind of scenarios. So yeah, I think we haven't ourselves put projections into the market, Hugo, yet as to target number of devices, but it's something we're considering and we've been discussing.
Because one of the things I heard thinking about the birth thesis is that your broker estimates that the break even will take more time than you are saying it will take.
Rapidly, Hugo, basically the break even point rapidly does have a little bit of a dependency on where the units are deployed. So of the four markets that we operate in, the UK, i.e. the UK, Denmark and Sweden, and the US. The US unit, even though it's very close to break even to loss making in the first year, is very profitable post that period. So if the growth is all coming from the US, the break even point accelerates. So you obviously get there quicker. And so it's something that we're obviously aware of. The other point that you touched on, talking about looking at our cash balance at the 31st of March of 4 million and looking at that, if you go back and look through the burn rates for the last quarter, you'll see that actually in this period of the year, our burn rate improves naturally. consistently, so it's getting better, which is why the statement that Craig made about cash flow break even at the end of the fiscal year and an EBITDA on a run rate basis is because actually month on month we're spending less. The net burn is reducing. So while we don't really need to raise any money. We've obviously had the remainder of the cash flow warrants, the outstanding warrants in July that have come in, which I think you touched on in your note. You talk about dilution, but actually it's not really dilution. It's equity. It's things that were already in issue, and there's a remaining 4 million warrants that are in the accounts that are due to go, and after that we're finished. So we're not planning on issuing any more. So the situation is improving, but the other key metric, as Craig has touched on, is the difference between a year one device and a year 2+ device, because you fully expense the device cost in the period. You can't see it, but within the cost of sales numbers in the stats, it's roughly about 2.5 million of device costs that's fully expensed. So even if you just say, let's assume they do the same revenue again, and that device cost doesn't exist, and the repair costs are the same, you immediately get to a 50+ margin, just on a standalone basis. And this is why the business is, so good, and it's got a very good prospects into the future, because we're building a massively cash generative asset that will continue into the future, with lower servicing costs in terms of repairs. And so it's the key thing is how quickly can we deploy the devices, and we're going at quite a rate. And I think the initiatives that are in play that Craig's touched on will only accelerate that expansion. But a US device is more valuable to us than a UK and a Nordic one. They both make money. They all make money, but they're just their margin is just slightly better because of the market dynamics in the US. And so just listening to your questions, sort of chip in.
Yeah. Great response. Thank you for that. And another question, a little bit of relation to that. You have a really sticky customer base that you're insured. I assume you have been hiking the prices during the last year. What are you thinking about your pricing power going into the future once you have a big install base?
Well, we've been successful at hiking pricing. I think when there's been justifiable reasons why we've needed to increase pricing, we've managed to partners have accepted that, and we've got the contractual mechanics to be able to do it. And obviously, there's been a lot of general kind of inflation in the market in the last few years. In terms of we have, I guess, strategic kind of pricing power insofar as there is no other alternative that can do what we do. So the classic kind of Michael Porter's 5 forces, when we're talking to an insurer, we are not ever in a procurement process against another supplier, because there isn't another supplier. So that leaves us obviously well placed, and it's not a purchase decision by our customers in any way based on price comparison. So therefore, the headroom on price is really down to the unit economics of the particular insurance book, and the degree to which we can reduce the claims. So that's really the thing that restricts the pricing. So it's not us versus someone else. It's just, will it work or will it not? And does it work across the whole customer base, or will it only work in a niche? And again, going back to where we started, Hugo, that's why we like the US market, because the economics work on market average economics across the whole of the US.
Yeah.
And contractually, we have the mechanism to increase the price on an annual basis with inflation and other sort of metrics. So all of our contracts have that in. Obviously, there is a point that when you're encouraging insurers to deploy, you don't lead with a price increase.
Yeah. Okay, and on leading following up on competition, it is clear that on a mass base, the prevention devices don't work. But I have been researching, and a subscriber and an investor who was thinking on the company sent me this device that is called Flume. I don't know if you know the company, but they have a really similar promise to you. And basically, for retail, they look for it's $250. They look to water. They control the amount of water the house consumes, and they also promise to reduce water claims by 80%. So it is also really easy to install. Like you can self-install, and they watch the leaks with something like magnetic or something. I did not understand the technology, so just to tap if you know the competitors and what do you think about their promise.
Yeah, I think the Flume device is interesting. Like I say, there's nothing at all that exists in the market that competes directly with what we do. So again, if you look at the Flume device, it's slightly unique in terms of it fits over the water meter. And it's basically using the ticks on the water meter then to be able to deduce the water flow. So it's much less sensitive than our device. It's more expensive. Like you say, it's $200 kind of upfront. But crucially, it doesn't include the repair service as well. So it's a combination of those factors together that add up to the proven ROI and the claim saving. And there really isn't any other device that's got any kind of major traction with insurers in the US or anywhere else. So I think Flume's one of the better examples. It's better than some of the solutions on the market. There's other solutions like Flow from Moen. That's a very nice designed product. That one needs a professional installation. It's a bit more expensive. So there are kind of niche examples where insurers have partnered with some of these solutions, but it's usually a kind of the consumer has to pay towards it. So none of them have really gained any kind of traction at all. So our model is very different, where we've designed a whole system to be free to the homeowner, self-install, and it's very easy to install. You don't have to go out to the pit in the garden where the water meter is located. Ours just clips like a clothes peg on the pipe. And we've proven that can be given away at such a price to the insurer that delivers a return on investment. So for a set of reasons, it stands apart.
Yeah, I completely agree there. And yeah, in terms of competition, there is little thing that people could argue, but the fact that some years ago there were a lot of these devices, mostly backed by venture capital, and I think this is one of the reasons why many people think that this might get commoditized in the future, which I don't agree with, because you have a patented technology, but how many years do you have the patent for the device?
I mean, it's a very long run on the patents. I can't remember exactly, but it's a long term. And the first, when was the first patent granted? It wasn't that long ago when we had the first. I mean, we've got 29 patents that surround the device. So yeah, we've got patent protection on one hand, but it doesn't even end there, Hugo. The various reasons why there's a moat around the business. So some patents, if you just read the patent, it's very obvious that how you could copy a product if only you could get around the legal restriction of the patent. It's not the case with our device. Even if the patent didn't exist, we've had a very long learning curve of all the ways we've perfected the way that the algorithm works, different elements that we've built into the processing, to how we curate the user experience to drive the right behaviors. It would be very hard and take a very long time, even if the patents didn't exist, for somebody to copy the solution in a way that would work as efficiently as ours. So even without the patent protection, I think it would be very difficult for somebody to catch us up using the same methodology. The other reason why it's difficult is even beyond the tech, if someone had the same technology, it's difficult to also copy the in-home service. And it's a bit of a strange nature of where our company came from, because it was spun out of a home assistance company. So part of the team that we broke away from HomeServe know the home assistance side of the operations very, very well. So we know how to do the plumbing service bit of this. And that also takes a lot of know-how. How to meld together an IoT tech product with an in-home service product is difficult. And then the final thing I would say is the actual, once we're in with a partner, it's very sticky because the devices are literally in the home. There's a huge amount of goodwill built between the LeakBot brand and the customer within, and that close tie to the insurance brand. And also, we've integrated to varying degrees with our insurance partners' back-end systems, their CRM systems. So even if another solution came along and tried to win contracts off us that could compete directly, it would be very difficult for them to do that, even if they could undercut the price. And it's not clear how they could have any price advantage. So I think there's a lot of reasons why we have got a really interesting competitive advantage. And I think you get that, Hugo. It's easy to overlook just how important that is in any business, and how hard it is often to attain. In anywhere where you can get that is a path to a high margin business.
Yeah, and I also think based off of data, you have a great mode there, because if someone is trying to get a new solution in the market, it will take years for them to get as much data to convince insurance as you have, because right now you have those big amounts of data that you can go to any meeting with an insurer and have something, lots of data, than check what you're saying. A new entrant will have to spend tons of money in R&D and in deploying lots of these devices just to have the same demonstrable ROI.
Mm-hmm.
Yeah, and
Yeah.
one last question on the other use cases you are finding for LeakBot. The first one is in Australia. That here I want to ask more or less uh, what is your budget for this type of other use cases? To know slightly what is your R&D to find these new cases, and then on the for the government, what to save water and all of these solutions that they are being talked a lot in the news. And I also think you mentioned that you had a contract with one of the government, or you were in talk.
Yeah, sure. So to take them in that order. So the Australia project is fully funded by the largest insurer in Australia, IAG. So we've been developing a solution that works in that kind of hot climate where the pipework is outside the property. The testing's gone well. We had to iterate a few times to get something that works, but the interesting thing is we got something that technically works. We're not saying too much about it at the moment. We've expanded the testing across Australia into 50 homes, but we think it might have broader applicability than we were initially intending. So we're not saying much about it at the moment, but we will say more about that project in due course. And your second point with water companies, I mean, we've tried a bit with some pilots in the UK with water companies. We delivered good results and showed that we could reduce a huge amount of water leakage. But it's a very different industry. We're hoping that a water company would kind of pick it up and do a kind of big deployment, but it's never really been our main focus. So we'll see. Things are still going. They work at their own pace, so we'll just see where it goes. But I think the conclusion we've reached as a board and as a senior executive team is actually the opportunity in our core market of working with insurers is so big that obviously the main thing we can do right now is absolutely double down and not lose focus making sure we capitalize on the opportunity that we've got right in front of us.
Yeah. Okay. So I think we've covered all of the questions shareholders might have, and I had, and great answers. I have learned a lot of new things that I did not know about the company before. So this piece I will edit it a little bit and put some thoughts and publish it on Substack on YouTube. And yeah, I think it has been a great interview, and I think solved a lot of people's questions about the company. So thank you.
Thanks a lot, Hugo. Thanks